Subscribe to our YouTube channel for in-depth interviews of India Inc. and press the bell icon so that you do not miss our updates.
Welcome to Nirmal Bank, ladies and gentlemen. I'm Hiral Dadia. We have with us Ananth Narayan, Professor Finance at SPJMIR, joining in. Welcome to the show, Ananth. Pleasure to have you back as well. Ananth, when last time that we spoke was for a period when we did see a negative 23-24% kind of GDP growth. Now, taking the revival into consideration with what's happening between September to now, what is your assessment of the growth for FY21? Because a lot of revisions have come through. Now the expectation on an average is between a -6 to a -8 or a -9 at the max. How would you consider looking at growth from here on?
Hi, Hiral, and thanks for having me back. So, look, clearly there's been a very good recovery and better than I guess most analysts, including yours, truly expected. I would go with the RBI number as the headline number, Hiral. So, -7.5% for FY21 sounds like a good number. I would have to caution, though, that these numbers are misleading. Look, these numbers, these first estimates are based on what we see for the organized sector by and large. So, and we know that corporate sector has done reasonably well in the second quarter. Sales is down, but, bottom line is up, right? Profits are up because of costs, etc. So it doesn't capture the fact that overall output is down. When industry shows a plus 0.6% growth in Q2, misleading, that's not right. So the point is, there's a lot of pain in MSME. There's a lot of pain in the unorganized sector. There's a lot of pain in the urban working class, which is not visible in the headline numbers. So while the headline numbers might come at -7.5%, the real number is probably in double-digit contraction here, and that's what policymakers have to work with. It's probably -10, -12, which apparently looks like -7.5%.
Right. So overall, Ananth, taking this print into consideration, when you talk about the rural recovery, that's what everyone's eyes were on, and that continues to be robust. Now, do you think the kind of rural growth that we are seeing, will it be able to compensate for the downtick in the urban market?
I think so, Hiral. So we have to look at this as a two-speed recovery. And rural sector, by the way, it's not just a recovery. It's actually done well over the last year because of various reasons. One is agriculture has done well. Second is a lot of the government schemes have been targeting the rural sector, starting from Narayan and other Kisan Yojanas, etc. as well, right? Third is COVID-19 did not impact the rural sector as much. So services and industry were working out there. So the pure rural, which is 65% of India, which was in the rural areas to start with before COVID-19, are probably better off than they were last year. So that's actually a good sign and explains a lot of the robustness that you see in the rural sales that many companies are reporting. Besides the rural sector, Hiral, there are also other sectors which are doing well. The urban salaried class is probably doing well, and they're recovering from, cost cuts and salary cuts that were seen earlier. A lot of them are seeing them coming back now. Likewise, organized sector, like we discussed earlier, is doing reasonably well. So there are these large swathes of the economy which are doing well. There's a lot of money in the system. So, deposits in the banking system, currency in circulation are at record levels, and they are prone to start consuming at some stage. At the same time, the point is there are large parts of the economy which are in deep distress. And that includes MSMEs, that includes, the contact services like hospitality, tourism, etc. It includes commercial real estate. So a lot of other sectors are in distress. Now, overall, what does this mean? It means that people have money, the rural sector, the urban rich, etc. They have money. Growth should come back, which is good. In a funny way, Hiral, it also means inflation is a risk. And it's not just supply-led inflation. It could also be real demand-led monetary inflation, which is a risk. So it's a very funny and paradoxical situation that we have to grapple with. My own bet is that in FY22, we will probably see a good recovery, maybe 9 to 10% headline recovery in GDP growth, with, unfortunately, a lot of inflation risks embedded as well.
Right. So, if you're talking of inflation risk as well, do you think I mean, in the end, the RBI will somewhere have to keep considering the inflation when they're taking any future steps. What is that number according to you till, the threshold till where the RBI can keep ignoring looking at inflation to get the growth back?
That's a great question, Hiral. Just a quick preamble to answering that question. Look, it's kind of paradoxical, like I mentioned. Our capacity utilization is supposed to be extremely low. We have a large negative output gap, which means there is a lot of waiting capacity to be utilized. And yet we're talking about inflation. Also, Hiral, no other country in the world, barring exceptions like Turkey and Brazil and Argentina, are really worried about inflation, right? The developed markets is forgotten about what inflation looks like. Even countries like China, which showed inflation, is now at negative inflation for the last month, minus 0.5%. Indonesia is 1.5%. So nobody really is worried about inflation. So why is it specific to us? I think it goes back to something, fundamental about our real economy. We kind of struggle to produce the goods and services that our consuming class requires. So every time you see an uptick in the rural demand, for instance, you see protein inflation going up, you see vegetable inflation going up, which we saw in 2010-13 also, we are seeing again now. Likewise, when the rural sector and certain urban sectors start to demand more goods and services, we see even non-food prices going up, right? So we see core inflation is pretty sticky at this point in time at 5.8%. So, and by the way, non-oil imports are back to pre-COVID levels. So we are not producing enough domestically. We either have too much money chasing too few goods, as in the case of proteins, or we start importing stuff, which means again, eventually it leads to inflation. So that seems to be a real economy problem that unfortunately RBI has to grapple with. Now, if the real economy was delivering the output that we were demanding, frankly, there would be no inflation. RBI could do what it was doing, right? Now, your question is, at what point does RBI have to start getting worried? I think even now, the RBI would be worried. Because while so far in April, May, June, you could argue that logistics and the fact that COVID-19 lockdown is stopping supply, and that's why inflation has come about. Now that argument no longer holds water. And you have to watch the money supply. You have to watch the fact that deposits in banking systems, the fact that currency in circulation, M1, which is the current account savings account and the currency in circulation, is growing at over 19% per annum, right? At a time when inflation is at 7% or close to 7%, and M1 earns you close to 0%. So why are people holding so much of cash, right? And that is something RBI has to worry about. Now, the point is, at this point in time, Hiral, there is no reason to hike rates or to suck out liquidity. Because in a very funny sense, look, there is no credit offtake happening. Why is so much of money being created? Why is money supply going up? It's not because of credit offtake. It's because of government fiscal deficits, and it's because of FX inflows, right? Now, normally hiking rates and withdrawing liquidity makes sense when credit offtake is the culprit behind money supply growth. So when you hike interest rates or you tighten liquidity, banks lend less, and cost of borrowing goes up, so people borrow less, and therefore money supply growth comes down. At the moment, credit offtake is 5.7% per annum. Where is the credit offtake, right? So if you hike rates right now, you do nothing to credit offtake. Instead, you run the risk of getting more FX inflows, chasing our high interest rates. So in a funny way, Hiral, right now, if RBI jumped the gun and pushed out liquidity or tried to take up interest rates in the short end, you could end up with higher money supply, not lower. And so therefore, now is not the right time for them to react. But they will be watching for two things, Hiral, I think. One is they'll be watching the credit offtake very, very closely. As that number starts to recover, maybe to 7, 8, 9, 10%, which I hope rate happens very soon, then they have to worry about too much liquidity, pressing out too much of credit, and that becomes an issue. The second thing, of course, that they have to worry about is what's happening on the FX inflows. As the FX inflows start to slow, they'll feel a lot more comfortable in hiking interest rates. So RBI is in a bind, and I guess in FY20, in the next calendar year also, they will be called upon to do magical things as they have done in 2020.
Right. So with this, Anand, when you talk about the credit recovery as well, what is it, according to you, that can ail credit growth? And do you think that the bank credit growth right now may be close to bottoming out?
I hope and pray so, Hiral. We desperately need credit growth, and that too going into productive investments, right? Look, there is much of investments required, and we've long made the point that credit to GDP for India is very, very low at 50-55%. That's very, very low. Why does that need to go up? First, a lot of money still needs to go into productive investments. And by that, I include not just roads and power plants and deep sea ports, but also things like education, healthcare, nutrition, sanitation, and so on and so forth. Both the government as well as the private sector need to do a lot of investments there. The problem for us, Hiral, is when we see such tepid numbers, and by the way, low credit growth was a feature even before COVID-19, right?
Correct.
We were struggling at 6-7% for a long, long time. So the problem for us is our financial services ecosystem is in no position to fund our growth aspirations. We've got a few very good banks which are in excellent shape. We've got a few other banks which are in okay shape. And then we've got a whole bunch of banks, unfortunately, largely the public sector banks, which are in no position to lend. They need more capital. They need to worry about their existing NPAs. We don't know what the NPAs really look like. We are in a cloud of ambiguity at this point in time. So the point is, between NBFCs and banks, the health of that ecosystem is in no position to fund our growth aspirations. That is the real constraint to our credit growth. Of course, along with the real economy issues. Now, the good news on the real economy, Hiral, is finally the government is doing a lot of right things to push through or create an environment for investments. Whether
Correct.
it is, this labor reforms, it's all controversial, but nevertheless, labor reforms, the tax cuts which happened in September last year, this PLI, production-linked incentives, and clearly the government is very focused on trying to increase manufacturing and get the supply chains from China, etc. It's going to take a long time, but at least there is interest around that. So hopefully the real economy part will get sorted out. But along with that, we also need the financial sector to be in a position to fund growth. It's not in a position. A lot of reform and cleanup is required before that can happen.
Right. So I am of the opinion that, a pickup in the nominal GDP growth along with a fall in lending rates is something which will stage the recovery in credit growth that all of us are watching out for, because clearly we are seeing a decline in the credit to deposit ratio as well, and that's something which has started to aid the transmission as well.
As I mentioned, Hiral, I'm actually hoping that we see a good uptick in credit growth. The good news is, as I mentioned, some large corporates are seeing good business going through. They are seeing top lines recover as well. Of course, everybody is waiting to see whether this is just pent-up demand catching up, or does this actually sustain into the next year as well. I'm guessing it will sustain, Hiral, because as I mentioned, there is money in the system, and there are people, whether it's urban, white collar class, or the rural section of the economy, which is in a position to consume as well. So hopefully we will see recovery continue. At that point of time, some of these good borrowers might start to think about fresh investments as well. I'm also hoping the government pushes through a lot of investments at this critical time, especially into things like infrastructure around Atmanirbhar Bharat, as well as things like education, healthcare, and nutrition, which will serve two purposes. One is, of course, to give a fillip to the current economy, and second, these are investments that we need. I mean, COVID-19 has shown us how desperately we need these things to be picked up on a big scale. I don't know if you caught this, Hiral, but we had the National Family and Housing Survey results, which came out a few days back. Shows terrible numbers in terms of demographics, right? Stunting is still at 35% in many, many states, which is terrible, terrible news for us, not just from a humanitarian perspective, but also from an economic perspective. Stunted children will not deliver us growth when they grow up. So a lot of investments have to go through. As I mentioned, one of the precursors to getting that growth in will be a much needed reform of the financial ecosystem. We need to remove the trust deficit there. We need recapitalization of the public sector banks. There are a lot of NBFCs which are still struggling with old commercial real estate loans and other kind of loans. They need a cleanup. We need a proper, control all delete of that ecosystem, recapitalization, and fresh reforms to ensure that we don't see a repeat of the past NPA excesses. So which means giving public sector banks the autonomy to operate as professional entities without interference from North Block and the Babus and Netas. Give NBFCs, maybe create a bad bank to remove all the excesses lying in the system as a one-time exercise, follow it up with good, strong reforms. So that cleanup has to go alongside to implement the real sector efforts that the government is putting in. And I'm hoping and praying in hopefully in the budget, we see something along those lines. And thereafter, we do see a pickup in investment and recovery.
Right. So with this, when you talk about an environment of, say, easy liquidity and financial, say, repression, do you think the disintermediation that we are seeing of credit by the bond market is something which will likely sustain from here on?
Look, we need all engines to fire, Hiral. The fact is, as I mentioned, banking system is not in great shape to at least to fund growth, even if they survive and they move on because of various reasons. Which means that the non-banking system, whether it's mutual funds, insurance companies, pension funds, or even good NBFCs, ought to be filling in the breach. Which means we need that vibrant corporate bond market to remain and to sustain. Likewise, we saw what happened in March, April, May with the mutual fund ecosystem, with those fears around debt markets, etc. So that market has to grow up as well. So I'm hoping that there is space for ample loan growth as well as corporate bond growth. Anyway, the regulators have been pushing the markets into debt capital markets away from loans. So, we do need that growth in capital markets to happen alongside. And there's plenty of room for both for banks as well as for non-banks. On the point of liquidity, look, and financial repression, which is a great point that you mentioned. It's a very good point. Look, a 10-year bond yield for G-Secs for Government of India bonds is about 5.9% now. It sounds like a very steep curve, 3.35 repo rate, reverse repo rate, and close to 6% as your 10-year bond yield. But even that has been repressed, as you rightly pointed out, right? It's been managed at that level because of RBI action, which includes steep rate cuts, a lot of liquidity, a lot of OMOs and operation twists and LTROs, etc. And of course, giving banks things like the HTM relief, allowing them to go and buy bonds without worrying about mark to market. Now, all this sounds great, keeping rates low for the government because it's borrowing a lot of money across center and states. I think this fiscal year they borrowed close to 20 lakh crores already. There's a lot of borrowing happening. But it's terrible news for savers. For savers who are looking at inflation at 7%, in fact, the RBI survey says they feel it's more than 10%. Imagine savers are getting now 5.6% as the average return on bank deposits. Post-tax, that goes well below 4%. So, these are terrible, terrible returns for savers. You are pushing savers into riskier asset classes. You are causing all sorts of other financial stability issues in the name of keeping yields low. For what reason, I don't really know. So there's a lot of regularization which has to happen. Government borrowings need to eventually come down, maybe through sales, etc. Have to be replaced by private sector borrowings and investments. And I guess the rates have to be a little more representative of where inflation, etc. So a lot of work still needs to be done, Hiral.
Right. And then when you talk about the debt market as well, especially when you talk from the FPI perspective, there's a lot of infusion that has happened through the FPIs in the equity market in the last couple of trading sessions. However, they have been aggressive sellers in the Indian debt market in 2020, and this does include government debt as well as private corporate debt. What is this signaling? Do you think we are likely to see them return back in 2021, or how do you actually paint the entire canvas with this scenario where the FPIs are pulling out of the debt market?
It's a great question again, Hiral. And look, the dichotomy between equity and debt markets has been puzzling to many people. Look, as far as the debt markets are concerned, we just talked about repression. The fact is, given where India's inflation is and therefore real rates are, the fact that at 6%, your 10-year bond yield is actually lower than the last print of inflation at 6.9%, right? So negative interest rates, real interest rates, probably push back global as well as domestic investors for that matter. Also, there are questions about the nature of India's true fiscal balance, particularly for the states, where there's a lot of question marks about how they're going to manage the huge holes in their revenue collections, etc. So, given the uncertainty around India's inflation trajectory, given the uncertainty around India's fiscal situation, which is unfortunately clouded by a lot of opacity rather than transparency, um, and the fact that India's overall macros have been under a bit of question over the last few quarters, I guess that has caused some amount of ambivalence towards India's debt markets. Few things which could change. Of course, a lot depends on how things move on the next year. We'll have to watch the data very carefully. One is India's aiming to get included into global debt indices,
Yeah.
bond indices. Now, there's a lot of work which has happened into 2020 around that. Hopefully, we see further progress in 2021. It is a painfully slow process, by the way. Don't expect it to happen overnight. But there is work happening in that direction. We should see good indications from the investors around that process because, by the way, global investors get involved in index inclusion. It's not done independently by an index administrator. The investors themselves get involved in the process. So we should see some good indications there. I think if we had less of repression from the RBI around the yields and therefore less negative real interest rates, we would probably see more interest from global participants. And I'm guessing that over the next few quarters, we will see some of that interest return. It does feel, Hiral, that global interest rates will remain low and liquidity will remain high for a long, long time, right? India's inflation is a question mark. But if we do get good news on inflation, and if we do get some stability around growth and the overall macro picture in FY22, I think global investors will come back to our debt markets.
Right. But when you talk of this, a couple of things is that the government is planning to borrow say a record of 13 trillion in FY21. The fiscal deficit is expected to scale up to almost 8% of GDP. Now, unless the Indian bonds actually give a real rate of return, a positive real rate of return, I think most of the global investors are not going to really be interested. So do you think India then needs to embark, say, on an aggressive debt market reform? Because till then, I don't think so it'll be easy for us to be included in the global bond indices.
Right, Hiral. So look, a couple of quick points. One is you're right about the financial repression and probably negative real rates are putting off global investors. The second point is a larger point. India doesn't really need global investors into debt markets at this point in time. Of course, on a medium term, long term basis, we do need to attract global savings. But look at the current context, Hiral. There's plenty of money lying around in the banking system at this point in time. Deposit growth has happened. M1 and M3 money supply growth has been robust. A lot of people are probably sitting on cash funds, having sold the equities to the FPIs and wondering what to do with the money, right? Do you put in gold? Do you put in equity? And nobody wants to put into, as you said, repressed financial rates of 5.5% in deposits, which after tax gives you 3.5% or something, right? So the point, I guess the larger point is the following. There is plenty of borrowing or money which can be borrowed from domestic markets itself. We don't need global borrowings at this point in time. What I would strongly suggest to the government, not that they listen to me, is that, listen, you should offer domestic savers a better deal. Yes, you want to keep overall interest rates low, but don't do it at the cost of savers, of cost of pensioners, the cost of older people, etc. Maybe offer a special borrowing scheme only for domestic savers at maybe 6% post-tax or tax-free or 7.5% pre-tax, right? Open it for a month as you would in the past open up for a special, IMD or a RIB scheme, a Resurgent India bond scheme for FCNR people. Open a bond scheme for local investors, right? You'll find a lot of money ready to come in at, I'm guessing even 5.5% post-tax, but let's say 6%. I'm guessing 3 to 4 lakh crores will come in a month's time, right? So open a window, you raise that money. That achieves a couple of things, Hiral. One is you solve the problem of savers. Instead of trying to buy gold or real estate or equity markets or Bitcoin, you have a great return of 6% post-tax from Government of India. Great, let's go for it. 7 years, that money comes. Second is you solve the problem of controlling money supply. What are you doing? You're taking money from me and then spending it on government packages and therefore putting the money back in the system. It's going from me to somebody else. You're not creating fresh money. Currently, you've borrowed almost 10 lakh crores from the banks and from the RBI. All that has created fresh new money and added to the money supply. So you curtail the amount of money supply growth, and therefore inflation problem gets under control as well. Third, if you build up some credibility around such a scheme, say, I will repay these bonds using the proceeds of disinvestments. And by the way, over the next 5-6 years, I will bring down my revenue deficit down to zero. And I will therefore make sure that all of this money I'm raising goes towards capital productive investments, infrastructure, healthcare, education, etc. I think a lot of boxes can be ticked if we go down this route. We don't really need to worry about global investors at this point in time to fund our fiscal deficits. There is enough savings available within the system waiting for avenues to be invested in to be tapped by the government.
Right. So with this, do you think that the RBI should actually go ahead and sterilize inflows through issuance of MSS bonds if the flows sustain?
Well, absolutely. Hiral, I want to quickly differentiate between two parts. One is the banking liquidity, and the second is the money supply.
Money supply.
Now, money supply is what can cause inflation if there is too much of money lying around in your deposit, my deposit, currency in circulation, and the velocity of money is very high. So we are doing a lot of economic transactions. That is the cause of inflation. That's what RBI should worry about. Banking liquidity is excess funds that banks are keeping with the RBI. It's not circulating in the system. It's not creating anything at this point in time. Where banking liquidity becomes a problem is it pushes banks to lend a lot more, right? So if as a bank I have a lot of liquidity which I'm dumping with the RBI every day, it's a huge carrot and stick to me to start lending more, buying bonds, buying CDs, CPs, whatever I can, and deploy the funds, right? So, but as we discussed right at the beginning, there is no credit offtake happening right now. So frankly, banking liquidity is not a cause of inflation at this point in time. It can become one if credit offtake was to pick up, right? What RBI has to worry about is money supply growth. And that has been robust. Like I said, M1 growth has been 19%. By the way, in the US, M1 growth is 50%. Okay. But US has zero interest rates. US has very low inflation. India does not have zero interest rates. India does not have zero inflation, has 7% inflation. So here M1 is a problem. Now, as we discussed, things like a special bond, a corona bond or something can be useful to control money supply. On banking liquidity, RBI has plenty of tools to control it whenever they want. Remember that CRR dispensation they gave in March, that's expiring in March of 2021. So if they don't roll over the CRR cut, you save you remove about 1.5 lakh rupees of liquidity straight away from the system, right? Plus, as you rightly mentioned, MSS is the easiest instrument that they can use and the least disruptive instrument they can use to suck out liquidity. It creates a lot of noise, Hiral, because between the government and RBI, they keep fighting as to who has to bear the cost of that instrument. But frankly, from your perspective, my perspective, it's a left pocket, right pocket question. It's the least of our problems. Let RBI and the central governments fight it out. MSS is by far the cleanest instrument to suck out liquidity.
Right. And then with this, when you look at the corporate bond market as well, the issuance is at record high levels. Do you think this will sustain, or do you think it could thin when the portfolio flows dry up? Because clearly corporates somewhere will find it difficult to roll over their cheap finances once the interest rates start going up due to rising inflation.
Right. Hiral, very quick points. One is while the issuances have been large, the total outstanding of corporate bonds and CPs put together they've grown, but not by that much, right? So a lot of it really is rollovers. Second, look, the curve is already pretty steep. So it's already factored in the fact that, the rollover cost is going to be very, very high. Just look at the GSEC curve. I think the 5-year bond is about 5.1%. And the 10-year bond is at about 5.9%. This already implies that 5 years from now, your 5-year bond at that point will be closer to 7%. So a lot of this higher cost of, expected higher cost of borrowing is already factored in the markets. when you're borrowing today at 5.9% rather than 3.35%, which is the 1-year T-bill or rate or whatever, right? You're already factoring in a lot of rate hikes coming through in the forward market. Now, your larger question is, will we see this growth in corporate bonds continue? I think it will, Hiral. I think it will. Like we discussed in the past, banks at this point in time are not in a great position to grow credit on their own. A lot of savers are looking for avenues to put in their money. As we discussed, there's a lot of money lying in as M3 as money in the circulation. So there will be money going towards mutual funds, insurance companies, pension funds. They will be saving of this money happening, and therefore there will be a demand for good quality paper. And add to that next year we should see some of the large organized sector hopefully increase their economic activity, increase their working capital, increase their investments, etc. I'm personally hoping that this growth in corporate bond markets will continue. Last bit here, Hiral, as we discussed, look, I think the regulators got a scare in March and April when the liquidity in corporate bond markets thinned down quite a bit. So a lot of steps are being taken to improve secondary market liquidity. And I think that will bear fruit and therefore continue to support the corporate bond markets going forward.
So I'll take it from the next question. So basically, Ananth, when we're talking of this entire, borrowing coming in from the corporate side as well, a lot of people are talking of the systematic risk, that's building up and stoking inflation. So if the corporates actually say fed off easy money at cheap rates and the central bank indirectly monetized government deficit, do you think that's what is going to happen?
Look, the risk of inflation is definitely on, Hiral. Besides the fact of money being in the system and money growth being in the system, there are lots of factors pointing towards higher inflation. One is we talked about a robust rural sector, right? And by the way, whenever terms of trade have improved in favor of the rural sector, we have invariably seen inflation, both core as well as non-core. Okay. Second, a lot of commodity prices are going up quite sharply as we speak. Steel prices, fuel prices in the petrol pump are going up, so those remain under pressure as well. Third is the fiscal deficits remain a problem, which means the governments, both central and especially states, will remain happy for taxes, and therefore things like your gasoline taxes, your liquor taxes, etc., will remain on the higher side. The government will be hungry for taxes. Fourth, if you look at sectors like power and telecom, at some stage tariff increases will come through here, and that will only add to the inflation going forward. Look, it goes back to the point that we discussed earlier. Despite all this, we should still have low inflation because after all, there's a lot of unutilized capacity. But our problem is we seem to struggle as an economy to deliver the goods and services which our consuming population want. So which means every time our farmers and our urban sector, etc., starts to buy proteins or plastics or chemicals or white goods, etc., we end up having too much of money chasing too few goods, or we end up importing, which is why our non-oil imports have gone up. So the risk of inflation remains high for all the factors I mentioned, and because as an economy we seem to struggle to produce what we require. I'm hoping the last part gets addressed. There is a lot of effort happening in the real economy to clean it up. I'm therefore hoping that domestic production, which is things like index of industrial production, things like our own production of pulses and oil seeds, etc., pick up over the next few months, and therefore inflation is curtailed. But apart from that, it does look like inflation is a problem. Now, if inflation is a problem because of lack of domestic production, RBI has no choice but to start to worry about money supply growth. And as you rightly point out, if we see credit growth picking up, which I hope and pray it does in the next year, if we see and FX inflows continuing and therefore money supply growth continuing, RBI will have very little choice but to start to worry about how to reduce the liquidity, reduce credit growth, and reduce money supply. Okay. I think that what RBI is hoping for is the following. I'm guessing RBI's mind here. Look, there's good news for us on the COVID front, and we were discussing before the show began, Hiral, which is we're not seeing a second wave as yet, and fingers crossed, toes crossed, everything crossed. So hopefully we get a vaccine also next year, and I'm sure the government will spend a lot of time and money on administering the vaccine across the country. So middle of next year, hopefully we are seeing economic recovery. The vaccine is being delivered. And at that point of time, we might be able to withdraw liquidity and withdraw accommodation without causing too much of pain around the economy overall. So I guess that's what the RBI is hoping for. But the larger point you make is absolutely valid. It does look like India has an inflation problem for a variety of reasons. So unless domestic output surprises on the upside and we are able to break that taboo that we saw in 2010, 2013, RBI has a job on its hands, very nascent and uneven recovery, and at the same time worrying about inflation.